All right. Good afternoon, everyone. Let's go ahead and get started. Let me forget. Less than ideal, but no pen. So. All right. Less than ideal. ZALMRH. All right. That's really weird. No pens. Okay. All right. Let's try that again. So, good afternoon, everyone. Let's go ahead and get started. First, questions or comments from anything that we've looked at so far? All right. Well, what I want to do today is move on from the topics. So, last week we were looking at conduct and compliance, really over the past couple of weeks. In the tutorial, on Thursday and Friday, we focused in on AI. And I want to pick up a couple of those points today. But in particular, let's start with the slides for today. So, starting point, a few sort of follow-on news stories from topics that we've been looking at. The first one that I'm going to pick up is really AI related, and it goes to this point that we were talking about in the tutorials around regulatory approaches to AI, drawing from those compliance and responsibility frameworks we saw last Tuesday in class. And this is a direct reflection of that. So this is Financial Reporting Council issues guidance stressing the need for human oversight in the context of audit reports. The UK's accountancy regulator has told auditors they cannot blame AI for audit failures, as it published what it calls the world's first guidance on how the firm should use the new technology. Quote, "You can't blame it on the box," Mark Babington, Executive Director of Regulatory Standards at the Financial Reporting Council, told the FT. "If you use this technology, you are still accountable for it. Accountability would remain with audit partners, not the designers of any AI," he added. His comments came as the FRC set out guidance for how firms should deploy AI tools, warning that these technologies pose risks to audit quality. Risks include misuse of AI's outputs, as well as deficient outputs such as hallucinations or distortions of data that could lead to an inappropriate conclusion in the audit. So this is, if you will, a direct reflection of that idea of finance as a regulated sector and the personal responsibility frameworks that we saw embedded as one of the core compliance mechanisms. The next one is drawing on from our discussion last Tuesday about unusual trading patterns in energy futures in the U.S. Ahead of a Trump announcement about negotiations with Iran. This is a sort of related story. Pete Hegseth's broker looked to buy defense fund before Iran attack. The headline makes it sound a bit more dubious than perhaps it was. Morgan Stanley wealth manager approached BlackRock about multi-million-dollar investment for U.S. Defense Secretary. Bit more detail. A broker for Pete Hegseth, the U.S. Defense Secretary, attempted to make a big investment in major defense companies in the weeks leading up to the U.S.-Israeli attack on Iran, according to three people familiar with the matter. Hegseth's broker at Morgan Stanley contacted BlackRock in February about making a multi-million-dollar investment in the asset manager's Defense Industrials Active ETF, the people said, shortly before the U.S. launched military action against Tehran. So, key point here is that it's not about individual stocks. So there's a particular difference when one is thinking about individual stocks versus something like this, which is a fund product covering an entire index. There's no question that if you had a senior government official looking to purchase stock in a specific company, particularly a company in which that senior official or department engaged in direct transactions, that would definitely be problematic. So in other words, if you were to have Secretary of Defense looking to invest in a specific company prior to an announcement of, for instance, a multi-billion-dollar defense contract with that company, that's pretty close to exactly what one looks like when we think about insider dealing. This, however, is a fund, which means that it isn't any single company. And that doesn't necessarily mean that that there are no issues, but it does change the context slightly. Now, this takes us to those compliance systems. The inquiry on behalf of the high-profile client was flagged internally at BlackRock according to people familiar with the matter. Now, this is something that's significant when we think about systems. We think about money laundering, for instance, in the context of AML regulations. We generally will have higher level scrutiny for what we call PEPs. A PEP is a politically exposed person. Politically exposed person, by definition, includes senior government officials. So from a money laundering standpoint, this transaction by a senior U.S. official would immediately draw higher scrutiny just because it's a senior official. Similarly, from the standpoint of trading, there will be higher levels of attention to any trade from a politically exposed person. And so this, we have the internal systems flagging that this would be a potential concern for greater internal investigation. Now, the fund itself, according to BlackRock, the $3.2 billion equity fund, which carries the ticker IDEF, pursues, quote, growth opportunities by investing in companies that may benefit from increased government spending on defense and security amid geopolitical fragmentation and economic competition. It's an interesting investment mandate. So that's interesting in itself. Its largest holdings include defense conglomerates RTX, Lockheed Martin, and Northrop Grumman, which count the U.S. Department of Defense as their biggest customers, as well as data integration specialist Palantir. Following publication of the FT's report, Sean Parnell, chief Pentagon spokesperson, wrote on social media site X, quote, this allegation is entirely false and fabricated. Neither Secretary Hegseth nor any of his representatives approached BlackRock about any such investment. BlackRock and Morgan Stanley declined to comment. Now, the investment discussed by Hegseth's broker did not ultimately go ahead, as the fund, which launched in May of 2025, was not yet available for Morgan Stanley clients to buy. Although ETFs are designed to be bought and sold as easily as a stock, their proliferation has meant that most big brokerage and trading platforms only carry a subset of the over 14,000 ETFs in existence. It is not known whether Hegseth's broker subsequently found an alternative defense-focused fund to make the investment. ETFs are popular with individual investors because they tend to offer lower fees and more favorable tax treatment than mutual funds, as well as being able to buy and sell in and out of them more quickly. So this, I think, is a good example both of internal systems and how those will flag potentially suspicious transactions for higher level of scrutiny. And also from the standpoint of another example where one has, if one is looking at sort of insider dealing, where there are potential concerns. Just a flag that it's not only U.S. senior officials. This is a story from Shen, so not as easily available as most of the FT ones. Former China securities regulator vice chairman indicted for bribery. And of course, if one is in a position where one is approving, for instance, listings or transactions involving listed companies, one is potentially in a position where you have inside knowledge, which you use, but, and this is something that we see a concern coming up frequently, is when you have a barrier decision. In other words, you have a government official which has the power to approve or reject something like a license or listing. This is a common point where there are risks of bribery. In other words, the ability to say, I will approve your application only if paid a certain amount, that is something that frequently can be a concern in a variety of jurisdictions. So, this specific example, a former vice chairman of the China Securities Regulatory Commission has been indicted on bribery charges, China's top prosecutor announced Tuesday. Prosecutors accuse Wang Jianchun of abusing his position to seek benefits for companies and individuals in areas including listings and financing in exchange for, quote, especially huge amounts of bribes. Now, we'll see this in just a second. The especially huge is actually a direct translation of a technical term. Under Chinese law, bribes exceeding 3 million yuan, about 425,000 US, are classified as especially huge and carry a sentence of more than 10 years, life imprisonment, or the death penalty, along with fines or confiscation of assets. So this term, especially huge, is a technical term suggesting the bribes involved were above this threshold amount. The charges relate to multiple roles he held within the securities regulator, including senior posts overseeing market supervision. Wang, in his late 50s, was a 28-year veteran of China's securities regulatory system and had served as CSRC vice chairman for 4 years. His case is said to be connected to his family, specifically a brother who allegedly held hidden shares in a publicly listed company. So, this is, full details aren't yet available, but it highlights this idea that issues around official misbehavior in financial services can also draw issues. Now, one more on the abuse and manipulation side. And this is one that we've talked about previously. So, we saw earlier in the semester high levels of volatility in the context of trading of AI stocks, and in particular a number of instances where the levels of volatility triggered the sorts of circuit breakers that we've looked at from the standpoint of volatility issues. One particular story that we actually looked at involved a small AI company which posted a report about the impact of AI on a number of other firms, including in the logistics sector, that caused major price drops across those firms. And this story is highlighting that we're now seeing some investigations around some of the trading behavior around that volatility. So this, once again, is something that one would expect. If one sees unusual market behavior, that will trigger an additional level of investigation to try to identify whether or not there's any level of manipulation or insider dealing involved. And I flagged a couple of weeks ago that one of the easiest places for manipulation to occur is what we call penny stocks. In other words, stocks that are not widely traded, and therefore the price can easily be impacted. And as it happens, the company that made the announcement is a penny stock, a small cap company with limited trading. As it happened, when the announcement was made, its stock price went up dramatically, whereas the stock prices of a number of the firms that it pointed out as being vulnerable to AI disruption dropped. And so, this story discusses a little bit of this. The karaoke company, the penny stock investor, and the 17 billion trucking route. Controversial trader John Fife invested in Algorithm months before its AI announcement triggered a surge in its share price and a market panic. When a tiny karaoke machine seller turned logistics firm triggered a $17 billion slump in one sector of the equity market last month, being February, one controversial penny stock investor was sitting pretty. In mid-February, Algorithm Holdings, note, Algorithm with rhythm, so it's a karaoke machine company that also does AI. So Algorithm. Then roughly a $6 million company. $6 million. This is tiny. This is an absolutely tiny firm. 10% of its total capitalization is 600,000. One can see how easily the possibility of manipulation could be present. So, in mid-February, Algorithm Holdings, then a roughly 6 million company that months earlier had almost been delisted from NASDAQ for not having enough equity, published a report saying its AI logistics platform had drastically improved efficiency in its Indian freight business. In a market jittery about AI's destructive potential, the impact was brutal. Around 17 billion was wiped off big trucking stocks in one day, according to Deutsche Bank analyst Risha Talwar-Hanan, in moves that were, quote, just bizarre and shocking. C.H. Robinson plunged nearly 15%, Expeditors International dropped 13%, and the benchmark 500 index tumbled 1.6% in one of its worst days in months prior to the Iran war. Algorithm's own shares soared as much as 450% over 3 frenzied trading days, boosted by a 3-minute appearance on Fox Business by Chief Executive Gary Atkinson, who called the firm's AI progress a, quote, rude wake-up call for the trucking and logistics industry. One shareholder was well-positioned for that surge, Chicago-based John Fife. The 65-year-old investor and philanthropist has made a habit of backing tiny stocks in hot sectors in a career spanning decades, tens of millions of dollars in profits, and multiple brushes with regulators. His firm, Streeterville Capital, invested in Algorithm last year in a deal that let it purchase several times the company's market cap in newly issued shares at a discounted price over a longer time. As the share price surged, Streeterville offloaded millions of shares, according to Algorithm's head of investor relations, in trades that could have earned $5 million in profits. Clearly, now in hindsight, it's worked out really well for him. Atkinson, Algorithm's chief executive, told the FT regarding Streeterville's investment in the firm. So, essentially this, entered into a deal whereby it is going to purchase new shares. And those new shares were going to be greater in value than the existing market cap of the company. So basically, as Streeterville is paying a sort of market free volatility price for the newly issued shares as they're made available. It is then immediately turning and selling those into the market when the stock has gone up by several 100%. It's a nice trade. This, from the standpoint of an investor, is exactly what you're looking to try to do. But from the standpoint of an exchange's or a regulator's market transaction monitoring systems, this is exactly the sort of transaction that will get flagged. In other words, it's a small cap company. Someone has bought a very large stake in that company just prior to some announcement or event that causes a very sharp spike in the price and trading of that company. Not to say there's anything objectionable about that, but to say that this is exactly the sort of data that these monitoring systems look for. In this case, it will trigger an alert. The supervisors will then look in and say, this is either something that may raise additional concerns, and if it does, they will then begin a process of investigation to get more information about the transactions concerned. Or they may look at it and say, no, this isn't anything interesting, just something that happened in the markets. So in this case, it looks like the regulators have asked for some additional information from the investor and the investment firm, as well as from the issuing securities. Yeah, that's probably the best bet. No worries. So, a little bit of background, and at this stage, in the investigation stage, weeks before its deal with Streeterville, it had sold, and this is Algorithm, the home karaoke machine business, which, as the singing machine company, it had operated for more than 4 decades. Executives had instead decided to focus on Simicap, an AI logistics company that Algorithm had bought, giving it a software platform to optimize freight capacity for consumer goods, such as Indian subsidiaries of Coca-Cola and Unilever. They needed capital to develop this business. They met Fife, who had financed another NASDAQ-listed microcap with up to $40 million earlier that year over Zoom. They were introduced by bankers at Univest Securities, whom they had hired to source funding, and struck a deal despite some issues with the investors' past. So, this is a pretty typical transaction in some ways. You have a company that is listed. That listing is valuable in and of itself. We looked at the very beginning of the course about the challenges of getting listed, the costs associated. The company essentially sold off one line of business, karaoke machines, and bought a new line of business to come into the listing. So it's changing its business direction. It is then going out to investors to say, we've changed direction, we have an interesting new direction, and we're looking for new funding. They have hired an investment bank. If you think about what investment banks do at the base of their business, they find money for people. And so that investment bank is constantly talking to investors who are looking for investments. And it's constantly talking to companies that are looking for investors and trying to match them up and charge a fee. In this case, the company is looking to raise additional capital to be able to expand its business. Investor comes in, purchases new shares of the company, which then puts the investment into the company, which will enable it to expand its business. So, it doesn't necessarily look an objectionable transaction. This is a pretty normal capital markets transaction, actually. But it is from the standpoint of looking at the trading behavior, this is exactly the sort of thing that you would want an electronic system to flag as being a potential concern. And it may still be. They're still looking into what sorts of information the investor had, what sorts of, if you will, interactions he and the company had with the investee company. But I think an interesting example that ties some of these pieces together. Questions on any of these market manipulation conduct stories? Yeah? What did I say was tiny? 6 million in market cap is tiny. So there's no way around it. It's in the context of a main exchange listed company, 6 million is tiny. Generally, if one wanted to say, this would make it a small micro cap. If you wanted to think about a mid-sized company, you're usually in the 10 to 100 million cap range. A larger company is going to be over 100 million. So anything less than 10 is going to be in your very small category.
Got two questions. First one is on the AI article, which is that could and should we shift to a model where we print AI sort of for the AI model creators and sort of group personality because they're getting importance and it's sort of the article says that the discretion of the end goes to AI and other streams, but ultimately certain ways around it. So what could be the response to this increased use and so this reliance?
Yeah, and the question is really what to do once you get to sort of fully independent AI. And I think that's an interesting question. In other words, if we look at the sort of human in the loop framework, or the human on the loop framework, the human supervision or involvement, whether or not there's a human that takes a final decision, or at least there's a human that is there monitoring decisions, that works very well in the finance as a regulated industry context. In other words, we've seen over the past few weeks that the licensing framework brings with it conduct and compliance requirements, which put specific requirements, specific conduct considerations on board, senior management, and actually even individuals as a matter of their licensed firm and licensed individual functions. So today, generally speaking in finance, if we're looking at the use of AI, we're not seeing systems which are fully independent. In other words, if one looks at a Citadel or a James Street, they are using very high levels of advanced machine learning models. And much of those activities, the trading actions, will take place automatically. But there is always at least a human that is monitoring for anything unusual. And the realization that if something goes wrong, like in the auditor's example, that the human will be responsible for it. And this is something that is very different in a regulated industry like finance versus tech outside of, say, the EU AI context. So EU AI context puts essentially horizontal AI regulations across every industry, but then it has certain aspects that are deeper in a sectoral context. Most jurisdictions don't have something similar. Most jurisdictions may have, like finance, a regulatory framework that covers whatever takes place in finance. And that makes the human in the loop or the human on the loop framework work very well. As we move forward, we are certainly seeing experiments in financial services where you have fully automated trading systems. In other words, systems where investment decisions are being taken purely by an autonomous AI. The amounts in those so far are relatively small, billions. So not inconsequential, but in the context of a lot of financial markets, not huge. So far, these fully autonomous systems are sometimes outperforming human systems, sometimes not outperforming human systems. Sometimes they beat the benchmark, sometimes they don't. And the end result is that so far, they haven't proven themselves as a business case. And as a result, we're still seeing limited movements into these. But one can imagine a situation where you do have systems that are being created. Then the question becomes, is the creator essentially potentially responsible for those? And in the financial services context, the answer is yes, in our sort of regulatory framework. But it does raise the question of, would it be possible if one had a fully autonomous system, for instance, to gain a license for that system? After all, the definition of a license holder is a person, but a person is a legal person. So in other words, if one were to create, for instance, a special purpose legal entity, which was only a sort of AI system, one could think about how you could apply for a license for that entity. But of course, as part of the licensing obligations, it would come with its own compliance requirements and frameworks. And we're not quite there yet, but this is something that one can easily say that at a certain stage, you could have fully independent, but if it was licensed, then the similar sorts of behavioral requirements would apply. And if it wasn't, then there would be the question about, clearly it's unauthorized, it's unlicensed trading. Is there a creator that is potentially responsible for that? And that's an issue that's a little bit outside of our discussions, but we do have some examples of systems which have been created which are fully autonomous. Bitcoin is an example. It's essentially fully autonomous. How it became that way is that the creator or creators under the name Satoshi Nakamoto dropped out. In other words, we have no idea what happened to whatever or whoever Satoshi Nakamoto was. But that person, group, etc. has vanished. And as a result, the system operates largely independently. And very difficult to find someone, since you don't know who this creator was, who could potentially be responsible for anything. So, that's an interesting example. We have another interesting example. I'll send you all a paper that looks at this question called Tornado Cash. Tornado Cash is a fascinating example. Essentially, it's what you call a crypto mixer. Essentially, it's designed to allow the mixing of digital tokens from a variety of different sources so that one is unable to tell the source of the resulting mix of tokens. And arguably, well, certainly it's very useful from the standpoint of money laundering because it makes unrecognizable, untraceable the specific tokens that have been put through that system. Now, we do know in the context of Tornado Cash that it did have a series of creators. At least one of those has been held criminally accountable in the Netherlands. Another was found criminally liable in the United States, but then pardoned. So, there's a mixed view on whether or not the creators of fully autonomous systems. And there is no question with Tornado Cash today that its creators, they have no control over it. They've thrown away the keys, it's fully autonomous, you can find it if you want. But that's an interesting example of a system that is fully autonomous, maybe not created for an illegal or malicious purpose, but certainly enabling use for illegal or malicious purposes. And then the possibility of the creators of the system being held responsible for its use. Good question. Others? Yeah.
I sort of had a second question on that last one.
Yeah.
So, I'm sort of looking at things the other way around, as you said, that this investigation wasn't completed. And so, what would be the effect of such an article or such news of sort of the regulator announcing its investigation? And could you sort of reverse the whole thing and say, well, in a way the regulator has manipulated the market? Is there a framework that allows this? And how could you sort of argue that, well, by publishing such a indicting article, if that transaction had nothing wrong with it, could it negatively affect the stock price and so manipulate the market?
Yeah, and you do see these, and actually the Chinese example is not a bad one, but you do see occasionally instances of regulators themselves leaking information or taking actions which do have an impact on the market and actually then are traded on or used by close associates and such. So you do see examples, and what you find is and it's embedded in the IOSCO principles, there are basically principles of confidentiality, of behavior, and these are then embedded into individual legal and regulatory systems as well. And so that's the expectation. You would generally, an investigation would generally be confidential until a point where there was an action or a warning taking place. And that's sort of the objective in these cases. But you do certainly see occasional examples where the regulator, the supervisor, is doing actions which could in fact manipulate the market for personal benefit. Yeah. Others? Yeah. So, this is actually something that, for instance, in the context of, say, tort law, that there's actually been quite a lot of discussion around strict liability for what one thinks of as dangerous instrumentalities. And it was something that often came up in the Industrial Revolution context. Someone would make something that was quite dangerous, someone would accidentally stumble through it and die. And then questions about whether or not the person who created it was potentially liable, even though they were exercising no control over it at the time. And so you do see in most of those cases the emergence in the 19th century of doctrines which essentially have frameworks for liability for the creation of dangerous instrumentalities. And so one can see some analogies in this context. And so there is then really two sides. One is something that is often around intent. In other words, were the creators doing something intentionally? And this is a fact-specific analysis. Sometimes they are, sometimes they're not. But the second aspect is, were they creating something that in and of itself created risks or problems? And with Tornado Cash, you can have arguments both ways. Were they subjectively trying to build something? They would always say no, others would say yes. That's classic sort of judicial decision. The other aspect is it inherently dangerous? Maybe, maybe not. So it's once again one of those things where you can take a view subjective. And we're now to the point where, for instance, the Dutch versus the US courts have gone different directions at this point in time. But it does highlight that there are risks as a creator of independent instrumentalities that you could be potentially at risk if something goes wrong. Others? All right. Let me pick up. It's almost 4. Let's take, because we're right at 5 to 4, let's take a 10-minute break, pick up at 5 after 4. And then we'll turn to the digital assets regulatory framework side. Hey, yeah. It's up there on the certain plans. It's up over there. Thank you. You're welcome.
Professor, may I ask,
Yeah.
is this the code for today?
That one is over there.
Oh, that one, right?
Yeah, 'cause
okay.
there's no pen
Because
today.
this is not working.
Exactly.
And may I ask, like, have you post the essay topic?
No,
not
we-
yet, right? Okay.
Yeah.
I
Yeah.
saw the assignment tab.
Yeah, but we didn't see it yet.
Yeah.
I'm guessing
We're hoping that we'll be able to do it tonight, but we're waiting on final approval from. Yeah. Yeah.
อะไรอ๋อดีกว่าเยอะไม่รู้ว่าพี่อยากได้100 ไฟล์แล้วมันก็จะแบบแนะนำอยากให้หนังสืออยากให้หนังสือตัวพวก LM คือดีที่สุดในการเอาเขาเรียกว่าไงค้นหาข้อมูลที่เรามีไฟล์มันแม่นเพราะว่ามันจะบอกแล้วมันเอามาจากไหนอะพี่มันจะมีลิงก์มันจะมีแบบจุดที่มาร์กอะแล้วเราก็กดแล้วเขาจะพูดว่าเอามาเป็นสิ่ง
This is
ไม่
one
พอ
of those
อัน
things
เนี้ย
where
มันขึ้นเลยพี่
once you get
พี่
a
สา
sort
มารถ
of
กดแล้ว
fact
ย้อนเข้าไปดู
specific,
แล้วผมก็จะไปไล่
in
ดู
other
ว่าอยู่หน้า
words,
ไหนแล้วก็ดูอ่าน
how
ถ้าไม่ตรงผมก็
is
จะถามว่า
the
แน่ใจนะ
system
แต่
set
คุณ
up?
ตีความถูกนะ
Particularly from the standpoint of the big concern
ถ้า
with
ทำงานผมไม่
these
สนับสนุน
is how do they
มั่วเก่ง
actually take
เจมินายก็มั่ว
funds
แต่ว่า
from
โน้ตบุ๊กเราเองถ้าบอกไม่รู้มันจะบอกไม่มี
This is where really, if there is a sort of regulatory issue, it will come. And if you create something that takes funds from retail investors without appropriate frameworks in place, you are potentially at risk.
พี่ไปมาเอง
Doesn't matter, create it.
Okay, yeah. But like, is there like, then shouldn't it be banned for retail investors to like invest?
In the banning, and I guess we'll talk about this a little bit later, it almost never works. And so, what the usual approach has been is to try to sort of apply to the extent possible the existing framework. And that's where we are with these. So far.
Yeah, because I don't think they have a framework.
No, but if you look at it from the standpoint of, say, an investment fund,
Yeah.
how is it taking money from people? And that's always where the issues arise, and that's where most of the sort of anti-fraud sort of regulatory framework hits.
So all of the investor protection rules also apply.
Depending on how the money is being taken and what it's being used for. And that's, we'll actually see a little bit when we look at the US new crypto approach, which is kind of exactly this. To basically say that if it is in this financial product category, then it's going to be caught. But if it's not, it's not.
Is that where the clarity?
Well, the Clarity Act will have a bit more on this, and there's some aspects, but yeah, it's sort of held at the moment. Yeah. Yeah. Hey. Let me have a look at that thing. Yeah. It's probably. The control is pretty primitive. It's set at 20. So, yeah. There's not even like an on-off button on it. So, that's the only control I can see. Yeah. No worries, and I agree. But yeah, that looks to be the only control that's in it. I'll send something around on that. Yeah. Yeah, it was mainly the 3 news stories. And so you've got those in the sort of material. So yeah, that's the, and you've got the recording. So the exam we're hoping to distribute it tonight, but we're waiting on final approval from the administration. We are going to distribute it just after class and then talk about it in the next one. Yeah. Yeah. Yeah, there's actually a lot out there, but actually not a bad place to start is from the standpoint of, say, the FCA's website, and they actually have some sort of guidance in terms of sites, etc. Yeah. Books and courses. That's, yeah, send me an email and I'll send you some suggestions. Yeah, there's a lot out there. Yeah. Right. All right, let's go ahead and get started. So, what I want to really pick up is moving to this digital asset discussion. And I think the key point is that we're seeing digital assets more or less 16 years after the genesis of Bitcoin as the first cryptocurrency. We're seeing a pretty rapid movement of digital assets becoming a regulated industry. We've talked about this idea around the regulatory perimeter throughout the semester. And what we're now seeing is a process where digital assets, at least to a certain extent, and we'll see how this applies a little bit later, but digital assets, at least to a certain extent, are being brought into the regulatory perimeter. And part of the big implications of this is that we are seeing an increasing integration between digital assets and related technologies and traditional finance and financial systems. And this is something that looks to be accelerating over the next several years. So, I want to pick up a number of big themes from a recent book with some co-authors. We've looked at this idea around evolution of digital finance, and I wanted to do something that I haven't done throughout the semester, which is a little bit of a quick evolutionary discussion from the standpoint of capital markets and technology. And in many ways, the transformation starts at the end of the 19th century. The ability to make instantaneous transactions as a result of the first intercontinental undersea telegraph cables really brought finance into our modern period of globalization. And it's certainly the case that almost as soon as the telegraph is available, financial information is being transmitted back and forth, and buying and selling decisions are being made on the basis of that information. We really see in the aftermath of the Second World War a process of first electrification, then digitization. And many of these processes we see the development of a wide range of technologies, including early computer technologies, code-breaking systems, power systems in the context of the Second World War. We then see a process in the aftermath of the Second World War of commercialization of these new technologies, including across the financial sector. And a key point that we see is something that, if you think about comparing and contrasting over time, the sort of UK securities markets with the US securities markets. Basically, throughout most of their history, the UK securities markets were basically in a very small place. In other words, you had the stock exchange, which had sort of evolved out of a series of coffee houses, all basically located in and around the City of London. Most of your investors were likewise there. You had stockbrokers who might be dealing with clients across regions and internationally, usually on a discretionary basis, but transactions were relatively centralized. And this is important because think about a world of analog paper-based securities where many of our legal frameworks originated. In other words, an exchange is just a place where people are buying and selling those pieces of paper. The purchase, the transmission of the money, the transmission of the share certificate would take place instantaneously in that face-to-face context. And as long as you're dealing with a concentrated area, small area, the settlement and payment of transactions can all take place pretty quickly. Contrast that to the United States. The US, by the end of the 19th century, had multiple commercial centers with stock exchanges. New York, Boston, Philadelphia, Chicago, San Francisco all had stock exchange systems, and US investors tended to be spread geographically in a much wider area than was the case in the City of London. And so that would mean that the settlement of a transaction, which might take place in New York or Philadelphia or San Francisco, the investor might be in Los Angeles or Boston or Pittsburgh, and the settlement, getting the piece of paper from place to place, was a real problem. And by the 1960s, US stock market volumes had grown to the extent where the paper aspects, the inefficiencies of the paper-based system, were both becoming a major challenge, but also a major risk. In other words, the pieces of paper moving around, the transactions might take place multiple times in a day. The lag between the actual settlement of the transaction and the actual transaction could be very significant, and that raised a range of issues. It's also the case that, particularly in the post-war period, you had a number of US investment firms, like Merrill Lynch in particular, that heavily targeted retail clients around the country. And so you had investors spread out all over the place, large volumes of transactions. And so in the 60s, a decision is taken to begin a process of trying to digitize these systems. In other words, creating, through immobilizing the shares in a single centralized depository, a mechanism where transactions didn't actually involve moving the pieces of paper around. Rather, instead, there was a centralized register of all of the securities, and the names could be quite rapidly changed. We see in tandem this process of digitization, and eventually this process leads us to the creation of the Edgar system as your sort of single disclosure framework in the 1990s. Big points where we see developments, always worth mentioning, 1967, 1968, a couple of big developments. We see the first ATM machine, which takes us from purely physical cash into early stages of digital money, which of course today, almost all money in many places is digital. I was thinking about this. The last time I used a physical British pound note was last August. I haven't seen a pound note physically in 9 months. Almost basically every transaction has been digital. And so that's a transformation process. The second piece that you really see in this period is the advent of credit cards. You see the advent of Diners Club first, American Express, then Visa and MasterCard. These were largely payment systems which then evolved into lending frameworks. And in some ways, the one that actually matters more than all of the others, the handheld calculator. In other words, the handheld calculator enabled much more rapid calculations than had previously been possible, which enabled much more rapid financial transactions. And it's really the handheld calculator that in many ways is the progenitor that eventually takes us both to today's smartphones, but also to today's AI systems and high-performance computing systems. We see in the early 1970s, NASDAQ, established in 1974 as the world's first fully electronic stock exchange. And of course, today, it's almost impossible to find a stock exchange that is not fully electronic. And so the interesting thing about NASDAQ is it was the first, but 1974 is a long time ago to think about establishing your first fully electronic stock exchange. And we see this process of digitization first in the context of traded capital markets. I mentioned that by 1987, the single largest point drop as a percentage in the history of US markets, that was probably caused by computerized trading, program trading. We see in the aftermath of 1987 of that crash, we see not only efforts to cooperate on setting regulatory standards, but we see the beginnings of the development of those exchange-based compliance and monitoring systems, which have now become embedded across, first, developed financial sectors globally, and really from the late 1990s in an ever greater range of emerging and developing economies. One thing that, if you think about it, particularly post economies that began moving towards more market-based financial systems from the 1990s, you can see in the context of Russia, its first post-Soviet exchange since the onset of the Soviet Union in the 1920s was fully digitized. If we look at China's exchanges established in the 1990s, these are fully digitized exchanges. And so you see a mix of systems whereby countries may have had older exchanges and then the creation of newer, fully digitized systems really from the 1980s. We see a parallel process in the context of payment systems. And we want to take 2007 to 2009, 2010, we see a series, another major inflection point in the context of financial technology. First, obviously, the iPhone. First iPhone is launched in 2007. And now we're pretty close to 2 billion sold from the standpoint of the iPhone. It wasn't the first smartphone, but certainly the one that really made it a mass market thing. And of course, the access to smartphones, first in developed countries, but then very quickly across the past decade and a half in emerging markets countries, as in many cases, they skipped older fixed line systems and moved straight to mobile phone in some cases, or in many cases, smartphone-based systems, has been transformational. The second is one that we've mentioned before, which is the M-Pesa example. Your first mobile phone-based payment system developed over feature phones in the context of Kenya that we then see now used on both feature phones but also smartphones across billions of people around the world. And of course, our third piece, the financial crisis, the post-crisis regulatory changes that had a huge impact, particularly from the standpoint of capital markets. The last piece, 2008, launch of the Bitcoin white paper by Satoshi Satoshi Nakamoto, whoever that might be, in late 2008, with the establishment of the first fully operational permissionless blockchain system in 2009. And over the past 15 years, we've had an acceleration of many of these changes, which then underlies the discussions that we had last week, particularly in the tutorials, around artificial intelligence. And 2 points that often are conflated, but I think it's very important from the standpoint of this course around securities regulation to separate. The first are processes around transformation of money and payment systems. And the second is about other forms of digital assets that are not necessarily monetary or payment instruments. And if we look at digital money and payment, this is not really our focus in this course, but it does relate to the broader discussion of securities regulation around digital assets. And if you think about this process, since the early 1970s, we have had a technological revolution in money and payment systems. And this couldn't be more obvious than that example of the fact that I've gone here since August without using a pound note. That's a transformation of money and payment systems. And it started with centralized systems like real-time gross settlements for large volume wholesale payments run by central banks. And it's moved across a range of other centralized systems today reflected in fast payment systems, instant payment systems in jurisdictions all over the world. And if we look at sort of an intersection between centralized systems and decentralized technologies, we can really see two aspects. The first is in the context of what are called stable coins. And I'm going to come back to those in just a minute. The second is in the context of central bank digital currencies. Central bank digital currencies so far are almost uniformly centralized systems, but they are a reaction to the challenges of decentralized systems and new mechanisms for money and payment. We see the advent of decentralized systems, first blockchain with the Bitcoin blockchain in 2009, but pretty quickly we see in 2013 the establishment of the first stablecoins. So Tether gets established in 2013 because, contrary to the underlying philosophy of Bitcoin, it happened that a large number of users actually wanted to be able to link the values of their cryptocurrencies to fiat currencies. And that's an important aspect. But it begins with Tether in 2013 and has increased. A major point, and one that really has led to a lot of the CBDC development, was the announcement by Facebook in July of 2019 of its intention to create something that was initially called Libra. Libra was meant to be a sort of cryptocurrency issued by Facebook, which could be used across users all across the world. And it never happened. Why didn't it happen? Oh, because almost everybody had some objection to the Libra proposal. If you think about it, one group has said that, maybe this is a good idea, but Facebook, we're not really sure we want you doing. Others said that, this is a disguised effort by the US and particularly the US government to get people to use the US dollar all over the world. And others said that actually this was an effort to undermine the US dollar by having a private company issue this digital asset outside of the supervisory framework. There were lots of others who had objections about consumer protection, financial stability, data use, just about anything. I remember, personal story, this is something that I was quite close to this when it was happening. A good friend of mine was one of the key people involved in the project, and he was, at the time, in my view, a rather idealistic economics professor at MIT. And I told him, once I saw the proposal, I was like, it's a great idea, but you need to spend some time socializing central banks so that they understand what you're doing. His view was very much the tech guy view, which is move fast and break things. We'll come out with our proposal, we'll have all kinds of discussions, and then we'll change the world. And the end result is eventually the legal and regulatory and the political processes made the project not really viable. And at the same time, it really created an impetus towards central bank digital currencies. We see in September 2019, the People's Bank of China announcing that in January of 2020, it was going to be rolling out a national pilot for its retail central bank digital currency, which was at the time called DCEP, Digital Currency Electronic Payment System, now generally called the ECNY. And with that Chinese announcement, we saw really an explosion, followed by dozens, scores, well over 100 central banks and jurisdictions around the world coming out with projects. Probably, in addition to the ECNY, the highest profile project being worked on the retail side today is the Digital Euro project. The intention to develop a sort of retail central bank digital currency as a digital payment system across the EU. The third thing it did is it triggered a global process via the G20 and the Financial Stability Board to develop a regulatory framework for stablecoins. That set of guiding principles is now being reflected in an increasing range of projects around the world and implemented by major jurisdictions. Switzerland was probably first, Japan probably second, the EU probably third, Hong Kong, Singapore, the United States have all been following more recently, and almost every week one finds some new jurisdiction that is coming out with rules around stablecoins. So, we'll come back to those in just a minute. The end result is that one can say, over the past several decades, we've had an almost complete transformation of digital money and payment systems. And we're now seeing this moving both at the retail but also at the wholesale level. We're seeing some of the biggest intersections around stablecoins, and I'll highlight why I say that. A stablecoin, by definition, is a tokenized monetary instrument, a tokenized instrument that is fixed in value to some commodity, fiat currency, or basket. Generally today in most of our regulatory frameworks, it's fixed in value to a fiat currency, a single fiat currency. And we see a variety of different licensing and regulatory models evolving. Some models are e-money-like. E-money essentially is something that developed from the 1990s. We see it in the context of an EU e-money directive from the 1990s. We see the use in the context of Hong Kong in Octopus payment cards, in M-Pesa in Kenya, in Alipay, WeChat Pay in the context of China. Basically, an e-money system says that you, as an e-money issuer, will get a license to issue money in a digital form, and how you do that is it's backed by an equivalent amount, usually held on deposit with a bank or central bank. Now, mostly e-money didn't prove very attractive because from the standpoint of the issuers, there generally wasn't a lot of money to be made. The exceptions were where you could get major scale. So M-Pesa, Alipay, WeChat Pay, Octopus in Hong Kong, all of these were able to get dominant scale, which then could allow you to add on other services, which could make essentially having to hold one-for-one equivalence attractive. The second model is a sort of bank model, where you have access to the balance sheet of the issuing institution, maybe have liquidity and capital requirements that go with it. The third that we see is much more like a money market mutual fund. In other words, there's a requirement to hold typically some form of highly liquid assets, which can include a mixture of cash and things like short-term government securities. And this, if we look at the Tether business model, the attraction of the Tether business model from the standpoint of Tether, the company, is basically you put your money into Tether. Tether takes your money and they invest it in stuff. They make money from the investments that they use your money to go into, and they keep it. Tether today is actually right around the 7th largest holder of US government securities, just ahead of South Korea and a number of other major central banks, which likewise hold billions of dollars in US government treasuries. So the attraction for a Tether of the business model was the float. Take the cash, put the cash in investments that would make money, and keep the income. Now, from the standpoint of the Tether user was using Tether often as a liquidity instrument in between trades in the digital asset markets. In other words, I mentioned this idea of bringing together traditional finance and digital asset frameworks. And one thing that has happened from a very early stage is you have had financial traders that have become involved in trading Bitcoin, other cryptocurrencies, and other digital assets. And they trade those just like they would trade gold or Exxon shares, traded in exactly the same way. Now that means sometimes you need to be out of a trade and you want a liquid instrument that doesn't have the risk of losing its value. And so you sell whatever your volatile investment was and you move into your cash equivalent, which was your Tether stablecoin. And so from the standpoint of many users, they didn't necessarily want the yield from Tether itself. They were looking at it as a safe liquid instrument. Of course, remember that prior to COVID, interest rates were negligible in any event. So you weren't likely to get much off of interest in any event. And it's only been post-COVID that interest rates have gone up and meant that the amount of money that Tether is making from the float on those investments is substantial. And that's a big debate right now, is in between questions of whether or not stablecoins can pay interest, can they pay yield? Because obviously if you are someone who is just using them as a savings instrument or a payments instrument, the ability to get some level of interest is better than not getting any interest. And so that's a competitive attraction. Many jurisdictions are limiting, often as a result of pressure from the banking industry, the ability of stablecoin issuers to pay yield. So that then takes us to what is kind of your third stablecoin model, which is actually, if it looks like a money market mutual fund, why not make it a tokenized money market mutual fund? And this is an area where we're seeing very rapid growth. We're going to come back to this because this is an important distinction. Once you become a tokenized money market mutual fund, you are straight into the securities regulatory framework. As long as you're issuing a regulated stable coin, you can target those jurisdictions which have stablecoin licensing frameworks. And as it happens, most stablecoin licensing frameworks are run by central banks and banking regulators. So generally speaking, stablecoins in most jurisdictions today are outside of securities markets and securities regulation. The stablecoin regulatory framework generally falls under the central bank and the bank regulator as a sort of monetary or payment sort of instrument. But other products may well fall into your securities framework. And this in some ways takes us to, from the standpoint of this course around securities regulation, what has been a very interesting experiment over the past 16 years. What I mean by that is the Bitcoin white paper and the genesis of Bitcoin and the initial cryptocurrencies. This was a direct reaction to what were viewed as deficiencies in the traditional monetary and financial system, which the 2008 crisis very much showed those deficiencies. Certainly across this course, we've seen that finance is a volatile, unstable system. It has all kinds of things that are less than ideal. And we spend a lot of time on regulation and infrastructure to try to get it to work reasonably well. And so, not surprising that occasionally someone will come up with an idea and say, this new system works better. And so the idea of Bitcoin is that it is essentially a technology-based alternative to traditional intermediary and regulatory and state-based monetary and payment systems. And that has and continues to have a whole lot of attractions. Now, from that sort of starting point, clearly the argument is that because it's a technologically based alternative to the existing system, that it doesn't need all of these regulatory frameworks that we've built for traditional finance. And therefore, it shouldn't be regulated. And in fact, its greatest benefit is that it isn't regulated and is not subject to supervision and control by governments or large financial intermediaries like the banks, which were rapidly failing in 2008 and 2009. And so, you get a very interesting, if you will, hypothesis. Does it need regulation in order to function properly or not? And I would say from around 2010 until COVID in 2020, by far the most common panel or policy discussion I was on was this question. Do you need to regulate these new technologies? And in particular, do you need to regulate digital assets, particularly cryptocurrencies? And it was an interesting group because in addition to this sort of philosophical argument, you had a number of other groups. We want to think about cryptocurrencies and digital assets from a sort of ethnographic sort of fashion. You have your crypto-anarchists first. That's your sort of core group. The second group is criminals. Criminals love this stuff. It was a great way to make transactions, particularly across dark web environments, and this is one of the first sets of problems that emerge. So that's a second group. A third group, which really comes on pretty soon thereafter, are your sort of video gamers. Video gamers, these are really your sort of stereotypical crypto bro sort of concept. And it comes from this community. And often, they were just dealing with this in the same way that they were treating anything else. And a very early point, you start to get a crossover, particularly from financial institution traders. Guys at Goldman Sachs, guys in hedge funds, coming in and seeing this new environment and trying to trade it the same way. And so you get, obviously the criminals don't want it to be regulated, that's clear. The crypto-anarchists believe that it shouldn't be regulated because that's the entire benefit of the system. And the gamers and the traders, actually, quite a lot of them said from the very beginning that they wanted it to be regulated. Why would they want it to be regulated?
Massive adoption.
Yeah,
Gives confidence to the public.
exactly. You get the institutional investors coming in, and the ability to have more and more participants and the trading volumes means you can make a lot more money. And if your objective is to make money from trading Bitcoin, then having a large population that is able to access and trade, that's usually valuable. And if you can get it inside the regulatory perimeter, you make a lot more money. Crypto-anarchists generally not so concerned about the monetary side, just find it really interesting. The criminals just trying to avoid these sorts of use cases. And that really then sets us up for something that has been very characteristic, particularly of Bitcoin, but of digital assets and cryptocurrencies more generally, which has been a series of boom-bust cycles. And it's something that after 15 years of this, you now generally, even in today's sort of down markets, there's a general acceptance that probably the prices are going to come back at some point. So we've now gone through approximately 5 cycles where you've had crazy increases in valuation, followed by a massive collapse in prices, and each time it comes back higher. And the end result is that kind of breeds a certain level of confidence. And now it's just accepted that this is sort of the nature. It's a volatile system. Now, if this was one of our critiques of traditional finance, clearly Bitcoin and digital assets, cryptocurrencies, suffer from exactly the same challenge. It's a volatile system. Okay, so we accept that it's a volatile system. That may have implications, but other aspects where we've seen first range, this sort of early adoption period, 2009 up to around 2013. And this is actually from a regulatory standpoint. You find 2 groups at this very early stage starting to be interested in Bitcoin cryptocurrencies. First group is as a result of dark web, Silk Road trading platform, the view that there was heavy criminal use in the system. And so you have law enforcement agencies becoming involved at a very early stage. And one aspect of that today is that amongst the largest holders of Bitcoin and major cryptocurrencies are governments like the US government, and often they have them because these have been criminal forfeitures over the last decade and a half. So, your first group is really from the law enforcement side, and related to that, this is the beginnings of one of our ongoing regulatory aspects, which is around money laundering and how or whether to bring digital assets into the regulatory perimeter for money laundering purposes. And there is a decision at a very early stage that they're going to come in. And so we see the standard setter, the FATF, the Financial Action Task Force, spending the next decade building international standards, which came out just before COVID. Those have now been implemented in almost every jurisdiction in the world. One of the biggest responses from a regulatory standpoint, 5 years ago, you would have people like Jamie Dimon, CEO of JP Morgan, saying that it's all criminals and terrorists using Bitcoin and crypto assets. But the reality is today, you've built a perimeter of essentially anti-money laundering regulation across almost the entire world, and that means that actually the majority of your users aren't criminals and terrorists, because you've brought it into the regulatory perimeter to push those out. Also happens, remember I was at a panel in about 2015 with someone very senior from Interpol, and we were talking, the panel was talking about enforcement. And his takeaway was that by 2015, so this is a decade ago, by 2015, major international law enforcement agencies like Interpol preferred criminals to use Bitcoin. Why? Because it's traceable. Wonderful if you're a law enforcement official, to be able to see where it comes from, where it goes from in different accounts. This, of course, takes us to Tornado Cash and why it's valuable. But if one thinks about this, the ability to have a technological framework that will give you spider webs of payment relationships, and then to be able to watch the accounts and eventually link those up to real people and real organizations, this is great. And so, law enforcement in many jurisdictions are very happy with criminals using Bitcoin in particular because of the traceability factor. We then see, in this next period, something that we see, which is throughout each of these cycles, boom, bust. On the upside, we see a broadening of the user base. In other words, in those early days, not many users. When we talk about that famous Bitcoin pizza transaction, where the guy is using a large number of Bitcoins to buy a pizza. And if you think about the value in today's Bitcoins of that pizza, it seems unbelievable. But at the time, the network effects were negligible. Very few people would accept this stuff. Small community. But each cycle, we've seen an expansion of the user population. And that, as we've seen throughout this course, brings with it concerns and risks at the same time. So, we see in this second period a major sort of broadening of users. And we start to see some significant developments in mining communities and the global use of Bitcoin. But it's also the case that we see the advent of centralized platforms and intermediaries. In other words, key to the story is that this is a decentralized system. But the percentages throughout the development of cryptocurrencies and digital assets who use the fully decentralized systems are always quite small. Today, 90% of users will use a centralized platform like Binance, Coinbase, etc. And that kind of eliminates some of those risk amelioration factors of having a decentralized system. And this is something that comes pretty quickly. You can say Tether, as a centralized intermediary, certainly has an early advent. And its scale means that even today, it is the single most widely used stablecoin, and it is a centralized platform for those stablecoins. Similarly, we see the advent of a trading system, Mt. Gox. Mt. Gox, beautiful system, essentially kind of like the flash crash that we saw earlier in the semester. A guy in a basement in Japan with a server, and essentially this was the trading system for the majority of Bitcoin. Clearly, he didn't necessarily have what we might think of as sophisticated risk management systems. Eventually that fails, and the Japanese legal system has to come to grips with insolvency aspects of how do you deal with these digital assets which had real value for a global user base at a very early stage. And it's at this point that we see central bankers starting to get interested in distributed ledger technology, blockchain, and crypto assets. One could really say three main reasons. One reason is, if you think about a lot of our discussions, central banks have always played an important role in payment systems, and so they're always interested in new developments and new technologies in payment systems. You look at the ECNY, People's Bank of China began experimenting with blockchain-based technologies around 2013. Deutsche Bundesbank, similarly, right around 2013, begins experiments because something that, from a legal side, we don't often think about. But your core technological systems, payment systems, trading systems, securities and settlement systems, each of these systems has a lifespan. And at the end of that lifespan, you have to replace it with something else. And so, from a tech stack standpoint, you will always be looking at new technologies and new systems to see how or whether these should be incorporated into your next generation systems. So that's one reason. Payments, people, and central banks are amongst the most attached to technologies and had an early interest. The second, clearly, central banks around the world since the beginning of the 18th century, but certainly everywhere from the beginning of the 20th century, had taken on an exclusive mandate for issuance of money. And so these new instruments are an immediate challenge. And so many central bankers had a very strong reaction. And we see lots of jurisdictions making cryptocurrencies, digital assets, strictly illegal from this period. And it's fascinating because we're now seeing over the last couple of years a fair number of those jurisdictions doing big U-turns. My two favorites, Indonesia and Pakistan. These were jurisdictions that I can remember very strong views in these jurisdictions about cryptocurrencies and digital assets, and now both are moving forward very rapidly from the standpoint of trying to develop systems. So, the second group is really your sort of central bankers who are concerned about Libra-type monetary substitution. And the last bit is monetary economists. Now, securities regulators tend to have a high population of auditors and lawyers. Lots of enforcement. Central banks, particularly those that are just responsible for monetary policy, they tend to have a high population of macroeconomists and monetary economists. And honestly, since the advent of the euro in 1999, and prior to that, the end of the gold standard in 1974, there wasn't actually that much of interest to talk about in monetary economics. And so this stuff comes along, and all of these monetary economists have something interesting to talk about. And they've been arguing for the past decade about all sorts of topics as a result. So, your central bankers come in, some have very strong reactions, some have very pragmatic reactions, but they're all talking, which eventually leads to all of those central bank digital currencies in the aftermath of the Libra announcement and the ECNY announcement. Coming out of Mt. Gox, market collapses. Just like after Silk Road, all the commentators say it's dead, it never had any value, it's not coming back, and then it comes back. And so we see the next iteration in what we now know, and I gave you a big long article on this, the ICO bubble, initial coin offerings. And initial coin offerings are something quite different to your cryptocurrency, quite different to your stablecoin. A lot of those initial coin offerings looked like a way to raise capital, to fund projects, which suddenly starts taking us into questions around, are these functionally investment products, or are they something else? And it's right around this time that you get, as the price goes up, you get a dramatic broadening in terms of investor classes. And this is one that you could really, certainly I remember one semester, every one of my classes kind of said we use these news stories as a framework for looking at the concepts to understand how markets are working and how regulation functions. In this time, we started out with Bitcoin right under $1,000. And by the end of the semester, it was 10. And a good chunk of my students had started out the semester when we started talking about it, buying the stuff. And so that was a really interesting process to see. But it was also really interesting from the standpoint of watching the ICOs. And it's always the case that whenever you have a boom in a market, at the top of that boom you can come out with anything. So think about our karaoke AI logistics firm, whose stock price went up by 450% in a matter of days. If you call yourself an AI firm, pre-Iran war, your price would go up. You didn't necessarily have to have a good story about what you were doing, but just by saying you were doing AI would allow you to raise money. And the ICOs were the same way. And some of these were huge. Block One raised $10 billion. $10 billion. This would make it one of the largest public IPOs. They eventually ran into problems because they didn't actually know what to do with it, and they created a foundation that now does philanthropy. But that highlights, at least they were a good case. A fair amount of them largely just wasted the money or took it and ran, as you'd expect. So, we see, as a result of the ICO bubble, securities regulators coming in. And these are often, at this stage, regulatory perimeter discussions. Is it a security or is it not? For a very long time, endless arguments about is it a security or is it not? And coming out of the ICO bubble, we begin to have more and more securities regulators treating these as investment products and developing regulatory frameworks. ICO bubble, as of course happens, collapses, and the commentators all say it's dead, it's not coming back, and then it does, as it always has so far. We see this aftermath of Libra, the ECNY, coming into essentially the COVID crisis, massive amounts of liquidity, increased trading. And there's always a point to keep in mind yourself. One of those points is there's an old saying in finance that anytime you hear someone say, this time is different, that's the time to sell. And this is the point where we were definitely hearing this time is different. The other is when your mother asks you if it's a good idea to invest, this is usually a sign that people who don't necessarily have a lot of knowledge of the market are coming in. And certainly it was at this point that I had a call from my mother saying, should I put all of my savings into this? And I was like, no. 5% sure if you have a risk tolerance, but not everything. But obviously you had quite a lot of people doing this sort of thing. And this is where we get the FTX collapse. And we'll look at FTX after a little short break in just a minute. But FTX really highlights a lot of the same sorts of problems in terms of conduct of business, centralization, risk management systems that we've looked at throughout the course. And coming out of FTX, you get in particular a major initiative from IOSCO to develop licensing rules and regulations for digital assets. And that kind of frames how regulated environment for a digital asset looks today. Most jurisdictions have rules around digital assets for AML purposes. Many jurisdictions have actually given responsibility for implementing those AML rules to the securities regulator. You now have an IOSCO process that is trying to enhance licensing, supervision, disclosure, enforcement, and segregation and custody mechanisms, which we'll see in the FTX example, were not in place as part of building a sort of licensing framework for digital asset activities in financial services. And finally, stablecoins, usually coming in the context of central banks and banking regulators. One area which is still definitely open are issues around what we think of as true DeFi. True DeFi, we've discovered, is remarkably rare, but it does exist. And it poses real questions about how can you actually deal with systems when they actually do happen that are fully decentralized. All right, let's take just a short 5-minute break, and I'll open the doors and try to get a breeze through this place, and then we'll go for the rest of the hour.
พี่เลยเหรอ
ที่เราฝรั่งเศสนะคะที่ไทยนะที่เลยได้อยู่
เชี่ยทำครั้งแรกเลยครั้งแรกได้ปีว่ะ
อะไรคือฝรั่งเศสเหมือนทำเป็นแบบ3 เดือนทำจะได้ที่คือได้
พี่จะไปฝรั่งเศสแล้ว
แต่ที่นี่ต้องเปิดเดือนเดียว
เราจะได้หลายถึงรอบนี้จะไปฝรั่งเศสแต่ว่าไม่นั่งยูโรพี่
มาที่ไปนี
นี่
Hey,
ตายแบบ
yeah.
ไม่มีเช็คเลยตอนนี้เที่ยวแต่อาทิตย์
ทำไหม
เดี๋ยวรอวิปกลับ
Yeah.
เพราะว่ารอให้มันออกเสร็จจะได้สลับ
จองกันนานอ่ะ
So,
ไปที่จองล่วงหน้าเลย
yeah, well, so we'll get in our next class, because our last formal class, because of the holiday, is actually on the Monday after. So it's the 13th, I guess. And we'll deal with it then. Yeah, yeah, yeah. Yeah. Yeah, no, it's a good timing. Here is quite good. Most of your top law schools now have people working on these issues. So, if you look at King's, at UCL, if there's anybody at LSE, here King's, UCL, Oxford, Cambridge, most of the US ones, yeah, there's,
But the thing with the US is that
yeah, fair point.
university actually got a really good deal from UCLA.
Yeah,
There's just a band that
Duke is nice actually. There's great people. That's a nice place. Yeah,
That's
yeah.
I do want to go for a PhD. It's I don't know if they have like specific research programs about it.
Everybody, I mean, not necessarily specific, but you now have, at most places will have people working on related issues, and so, yeah. And, yeah, if there's a university that you're looking at, let me know and I can tell you who is working on
Yeah, and if I were to ask for a recommendation for you,
Yeah, happy to do so. Yeah,
I've already made him my CV.
yeah, no.
I'm happy about that.
Yeah,
Yeah, just take your time whenever. Pushes on.
Yeah.
That's what we
No, it's, and for this topic, yeah, it's a good time. There's a lot going on from a lot of different directions.
And it's like the academic version that's more useful. There's no certainty, there's like no
ผม
clarity on what's
พี่
gonna happen.
คือพี่ผมว่าพี่เขาว่าเรียนที่นี่เหมือนกันที่ลอนดอนเพราะว่าลอนดอนไม่ค่อยได้เที่ยวเลยแบบ หลายจุดอะที่ไม่ได้ไปแต่ว่า
Or
ไป
you
ไป
know,
ยุโรปมา
you
3
come up
4
with
ร
a
อบ
hypothesis, and then
แต่ผมเองไม่ได้ไปยุโรป
it's you know it's interesting because the
เพราะ
world
ว่าไอ้วิทย์มันลอยให้มันจบ
come along and tested these hypotheses, which has been fascinating.
ๆพี่เจ้าเนี่ย
Yeah.
เฮ้
Hey.
คือไปติ๊กไม่ดีนะ
ปีนี้เลยเคยมีแล้ว
คือแบบไม่เลิศอ่ะถ้าคับเซิลบอยดีอ่ะ
I don't know if it is
ทั้ง
about
ที่ผมก็มีนะ
class.
ที่แบบจ่ายแล้วกระเป๋า
There is no sound to download. So like it says it was released on
I'll say something on this in just a minute, because obviously
I don't know if someone asked you already.
No, then I meant to say something about this, so I will. And yeah. Hey, yes. Yeah. I think we don't know. Yeah.
Because I saw all of the other modern
Yeah. So, well, I'll say something on this in just a minute. Because yeah. That's great. Okay. Say something about the exam shortly, but no, yeah.
So we're really not participating in this.
I'm sorry.
I had a question, so digging into cryptocurrency.
Yeah.
I'm really interested in AI. So we see that a lot of corporates have digital cryptocurrency. Is that true?
It is a fair number.
And what is happening with cryptocurrency now?
So you've had some impacts on balance. Yeah, exactly.
So I digged into M&A waves over the last 40 years, from 1980 96, so 6 years, 7 years. Do you think it will trigger a new
they're still targeting now with the
Yeah, we actually have
assets
seen some of this.
freeze.
We have seen a couple of examples where, for instance, the value of Season's Bitcoin treasury has dropped dramatically, and then others are looking at buying. Yeah, so we are seeing some of this. I wouldn't call it a wave, but we are seeing some activity.
Yeah, since I was thinking I wanted to do maybe some research into this, I don't know if there is
I mean, definitely there is. You know, it's funny. You already had a consolidated industry around finance and Coinbase, but now you are seeing consolidation around the others, which is interesting. That's one way about it. It's just something I've been doing for a long time. Yeah. Yeah.
From Queen Mary, since one of the things is students participate.
Yeah. And in fact, send me a note because send me a note. Send me a note because there actually is something. Yeah, send me a note because there actually is something, and this could be good. So send me a note with a CD. Go ahead, just send it to us. Not necessarily, but just send me a CD because I already know what it's good.
To your Queen Mary.
Yeah, that's good. All right, let's get started. So, the takeaway here is, of course, after the crypto winter, once again, all kinds of things say that it's not going to recover, and then it does. And now we're in yet another down cycle, and so it's a volatile sort of market that seems to be just kind of the nature. One thing that you are now seeing is very frequently, particularly with Bitcoin and crypto assets, you don't necessarily see many people arguing that Bitcoin is a monetary alternative. Because of volatility, because of a range of reasons. Generally, I think what many will now say, what I will generally say when describing the market, is that cryptocurrencies, particularly Bitcoin, have become an asset class. People trade them like they trade other commodities and financial instruments. And that's an interesting evolution. It certainly wasn't what the crypto anarchists had in mind at the beginning, nor was this idea that one would bring them into the regulatory framework to allow pension funds to invest. But if we want to look at our sort of framework of regulatory objectives, we talked about monetary stability, financial stability, efficiency, market integrity, investor protection, consumer protection, and innovation and development. And if we look at those 6 regulatory objectives, our experiment over the past 16 years with Bitcoin, cryptocurrencies, and digital assets has basically highlighted that these concerns exist in each case. And so, over that past decade and a half, we've basically brought in regulations around each of these aspects so that today, from the standpoint of digital assets, they look much like any other sort of commodity or financial instruments in the market, both from the way that they're used and traded. Yeah.
Sorry, we should close the door.
Yeah.
Interrupting the- Sorry about that.
No worries. The trade-off between air and noise. So we lose air to reduce noise. from a regulatory standpoint, increasingly, as we're going to turn to in just a minute, treated similarly because the same sorts of problems have emerged. This doesn't mean that the technology isn't tremendously useful for many things. It just means that the same sorts of issues have arisen. My hypothesis, and an interesting one, is that it's because you've involved humans. If you have humans, human behavior is going to result in fraud, crime, manipulation, misbehavior, panic and herding effects. And at the end of the day, as long as you have people, these can't happen. These will happen, sorry. But it does leave an open question, which goes back to an earlier question, which is, what if we end up with markets without people? Raises first a question, can you have a market without people? In other words, if you're just doing essentially independent AIs trading with one another, is that a market? Open question. Likewise, if one is thinking about an agent-based market. Actually, what we're seeing in the context of agentic systems, they seem to suffer many of their own behavioral oddities, some of which are similar to human behavioral aspects, but others of which are different. So just having a market filled with AI agents may not necessarily solve the issues either. But the end result is, after a sort of 15-year experiment, there's a general consensus that the markets probably work better if they're regulated. And I very rarely have a circumstance where, for instance, I'm in a discussion with somebody from the industry who doesn't have that viewpoint. Yeah, that's often a danger sign, but that's a different issue. So, before we look at the sort of US and UK approaches, which sort of embed this in, I do want to take a quick tour of this now. Yeah, that's as large as I can make it. This is the FTX group structure. Now, in some ways, the amazing thing is that they actually did have all of these different legal entities and contracts and things. When in the context of how the cash flow worked, basically it was, as long as enough money came in that covered what they were spending, they were okay. And when money stopped coming in and it no longer covered their expenses, it all failed. That was basically the sort of fundamental problem. But if you actually look at our sort of detailed, and in some ways, your three key pieces are this: FTX trading, FTX ventures, and Alameda research. Now, the design of the structure is remarkably similar to Citadel, which is in some ways not surprising because Bankman-Fried and a number of his colleagues were coming from Jane Street. Jane Street, our giant sort of electronic trading firm, and taking many of the processes and systems from the Jane Street environment to the digital assets market. And in fact, that was his big pitch. His big pitch is that he was taking the sophistication of Jane Street, which was seen as the most sophisticated sort of automated technical trading firm, and applying it to digital assets. So the Bankman-Fried pitch was really that he and his team were taking the best of traditional finance and applying it to the digital assets world. The problem was that they never actually got around to doing that. They just kind of made it all up. But they did have a complex corporate structure. And there is today still a very open question, which was that did SBF, Sam Bankman-Friedman, actually, was he a sort of criminal mastermind where he had developed this entire system to suck billions of dollars from people all over the world and then essentially fund his own activities? Or was he really just sort of an idiot who had a great pitch but had zero management capabilities whatsoever? And both of these stories can still be equally valid depending upon your point of view. We have no certain answer to this question. But if you look at the structure, FTX trading, this was meant to be an exchange. And something that I've tried very carefully to do, certainly since the beginning of the course, is I've never called a digital assets intermediary an exchange unless there's something like Coinbase that has an exchange license. The term exchange, as we've seen, is a technical securities regulatory term, and it shouldn't be used just to call yourself an exchange. But what they've attempted to do in many cases is use that regulated terminology, that trust framework, to suggest a higher level of trustworthiness that might be backed by a regulatory system than in fact exists. So, core, the exchange. But the exchange really was much more like a market-making system on paper. On paper, the market-making system essentially was meant to be an automated framework that would match buy and sell orders like an exchange, but in some ways more like Citadel on both sides of the transaction. You essentially had automated buyers and sellers who would buy and sell. But it didn't really operate that way, because basically what would happen is they more or less just put everything into one account when money came in, and as they spent money, it went out of the same account. It wasn't really a trading system, but in theory, it didn't even really operate like an exchange. It operated like a Citadel-based market-making system. So that's piece one. Piece one of your group was meant to be an exchange, but really an internalized intermediation system across the books of the firm. No segregated accounts, everything in one account, and essentially only money comes in, money comes out as your operating model. Alameda Research Ventures. Alameda Research Ventures was meant to be your sort of broker-dealer. In other words, this was the firm that they would take clients' money and invest for those clients on a discretionary basis. So this was meant to be a sort of asset manager, broker-dealer. And they were taking the money and investing that money via their exchange, which raises some concerns, even if it's all set up properly, that essentially you're running a trading system, and you're then using that trading system, which you own and control, as a means to trade the assets of your clients, which you manage on a discretionary basis. And your third piece, FTX Ventures, was essentially an investment fund. In other words, FTX Ventures would invest like a venture capital firm into interesting cryptocurrency and other sorts of projects. And it could use both the founder's own money to make these investments, but it would also use client money from the standpoint of the broker-dealer investment manager to invest in these products, and eventually it might exit these positions via the exchange. So essentially what they were building on paper was an integrated group, essentially a market-making system, an asset management or investment system, and a sort of, if you will, venture capital firm, all tied together in the same institution, and looking remarkably like a complex securities intermediary, but of course with none of the licensing, disclosure frameworks, auditing frameworks, or the like. And eventually, as usually happens in these circumstances, at some point the market starts going down. There would be questions about more people wanting to get their money out than put their money in, and in particular a relationship with Binance, where there was a decision publicly expressed by Binance not to provide liquidity to FTX in what was viewed as an emergency situation. And what usually happens in those circumstances, we can think about Credit Suisse as another example where the Saudi National Bank declined to put in additional money at a certain point in time, and that triggered a loss of confidence in the institution that meant massive outflows, and the end result was the failure of the organization. FTX, very similar. Binance determines not to advance liquidity to FTX at a crucial point. That causes a loss of confidence in FTX and a quick realization that actually this sophisticated veneer was a fraud, either a carefully designed fraud or just a sloppy fraud, but either way, a gigantic fraud and a gigantic insolvency. And that really was the last push to basically say that digital assets in many ways by 2022 were acting just like our wholesale capital markets that we spent so much time on across this course, but they were operating outside of the regulatory environment. And what we would call that is regulatory arbitrage, basically undertaking the same activities outside of the regulatory perimeter as opposed to inside the regulatory perimeter. And that has, if you will, reinforced movements to regulate the industry, and the fact that it is quickly becoming a regulated portion of finance. Now, I want to do two quick things. The first, assessment essay. Daniele and I, our target was to distribute it immediately after class tonight. I don't know whether Daniele has done that, but we had sent it to the administration for final approvals earlier, and we were still, when I came into class here, we were still waiting for final approval. So as soon as we have that final approval, one of us will release it. And then at our next class, in addition to talking about SPACs, we'll also talk about the question structure. So yeah, my apologies. We thought we were going to be able to distribute it just after class, but unless Daniele has managed to distribute it while we've been in here, we were still waiting as of 3 o'clock for approval. So sorry. Okay, but you'll have it soon. So, I gave you guys 2 other links. One is essentially a brand new interpretation, essentially a rule issued by the US SEC and the CFTC, laying out how they're going to treat digital assets going forward. And I'll come back to that in just a minute. What I want to flag first, though, is actually the UK approach, which in some ways very closely reflects the discussion that we've just gone through in the context of evolution of regulatory approaches to digital assets. And I've given you on this slide essentially 5 pieces. The first is the FCA's crypto roadmap, which actually in a sort of timeline function highlights their implementation of a number of these milestones that I've just highlighted from a regulatory perspective. The second, which is essentially about treatment of crypto asset related activities, and this is really useful because it gives the pieces the regulated activities, because the UK has done its usual approach to new products, which it has created a series of new regulated activities which are subject to licensing and authorization, and then bring with them all of those conduct and compliance mechanisms that we've talked about. Financial Services and Markets Act order, this essentially highlights the definition being used in the UK for crypto assets that are then brought in through these regulated activities. And finally, the full regulation, which is due to come into effect in 2027 and amend the Financial Services and Markets Act to essentially put in place a legal framework covering all aspects of crypto assets as defined in this framework. So, we want to pick up the roadmap. And if we look at the roadmap, you can see stablecoins, and I've largely left stablecoins off of my framework. Why? Because they don't fall under the securities framework. They're under the supervision of the Bank of England, the PRA, and therefore it's a monetary and payment instrument outside of the securities context. But we can see money laundering regulation here. We can see financial promotions, which is around essentially market manipulation issues. And certainly something that we saw really throughout crypto is there has always been a substantial amount of efforts to manipulate markets. And it's interesting because you've always had one group which actually has said that the entire basis of digital assets is essentially self-responsibility. And that means that anyone investing in these markets knows or should know that essentially it's a buyer beware system. And if I'm able to lie and cheat to be able to take your money, that's fair in this world. And that has been a long embedded view, particularly in the context of some of the more technical sides of market participants. But it's something that has raised a lot of issues as markets have broadened to wider retail participation and concerns about market manipulation and its impact, particularly on less sophisticated retail investors. Stablecoins, we get the movement to issuance and custody and final rule frameworks. Admissions and disclosure. This is the idea that one needs to have disclosure frameworks around crypto assets, both for investor protection, but also to help the market work better. This has actually been a key challenge, is that if the quality of information about digital assets isn't very good, it makes it difficult for the markets to price them well and for those markets to function. So a real focus increasingly on disclosure, admissions frameworks, market abuse provisions, trading platform rules, intermediation rules, lending rules, staking rules, and prudential considerations, custody rules, conduct and firm standards for behavior, and finally the various pieces all come out in final format. And so you can actually see US regulations, as you started to probably pick up, are often very difficult to read. And that's not necessarily intentional, but often we talk about rules-based systems versus principles-based systems. And US rules-based systems means that really the rules are very, very detailed. Hundreds, thousands of pages is pretty normal. And that can make them somewhat difficult to read. The UK sort of more principles-based system is often a little bit clearer, though they have in the past decade started doing something that does make life a little bit difficult, and that is when you look at something like the crypto asset regulations that make a series of amendments across existing legislation, it can be in some cases difficult to see what it's all going to look like. In this crypto assets regulation though, it's actually pretty much everything is in the regulation, which means that it's pretty easy to read because you're not just trying to figure out, all right, they changed this paragraph and this clause and what does it finally say? Because the regulation covers almost everything, it gives you a pretty clear way to read through. Now, so this is about the regulated activities, the Financial Services and Markets Act, and the FCA rulebook. So, regulated activities. The activities we regulate, as we've seen across the semester, are probably set out in the Financial Services and Markets Act, regulated activities order. These regulated activities require authorization before firms or individuals can carry them out. The Treasury's statutory instrument will, when it's finally implemented, create a number of new regulated crypto asset activities which are then to be added to that regulated activity list that we looked at when we looked at intermediaries and authorization. So, issuing qualifying stablecoin, safeguarding of qualifying crypto assets and relevant specific investment crypto assets, arranging for another person to safeguard qualifying crypto assets or relevant specified investment crypto assets, operating a qualifying crypto assets trading platform, an exchange, dealing in qualifying crypto assets as a principal on behalf of others, dealing in qualifying crypto assets as agent, in other words, being a broker-dealer, arranging deals in qualifying crypto assets, making arrangements with a view to transactions in qualifying crypto assets, and qualifying crypto asset staking. So essentially what you get is essentially the idea that you bring the crypto asset activities into the regulatory framework in a parallel manner to the existing regulated activities. This then gives essentially the details around how their new rule book system will operate. So we just looked at regulated activities, authorization, supervision, and enforcement, standards really relating to conduct, introduction to the senior managers, certification regime, and the operational resilience mandate. So basically, once the system comes in 2027, essentially it's a comprehensive treatment for crypto assets in a very similar way to traditional sorts of financial instruments and activities. Direct legislation. There are certain aspects that are a little bit confusing to read, and this is one of them. So, the confusing bit, and I'll just pull this up for reference really quick. If we look at the Financial Services and Markets Act 2000 crypto assets regulations, this, as I said, is pretty much in the same way the Financial Services and Markets Act was designed to be a single piece of legislation governing all aspects of financial services in the UK at its design in the late 1990s, and is held up pretty well. They've stuck with that pretty reasonably well. This crypto assets regulation is largely designed in the same way. In other words, if you are like a jurisdiction around the world and you want to see what does a potential crypto assets framework look like, this one is remarkably easy to look at and say that it contains all of these elements, which one can then use as a sort of guidance in thinking about how to develop legislation in other jurisdictions. And this is a contrast to the US system, which, as I said, is not easy to do. It's a contrast to the EU system because the EU system, actually you have what is called MiCAR, the Markets in Crypto Assets Regulation. But the problem with MiCAR is that it just covers a limited portion of the digital assets universe, and it explicitly excludes digital assets which are financial instruments. Which means that basically from the standpoint of digital assets which are financial instruments, you start with trying to figure out the entire EU framework, which takes us back to our earlier discussion. If we look at this one, the FCA, the Financial Services and Markets Act 2000 Crypto Assets Regulation, we can see that it's remarkably clear. Your general principles, designated activities, qualifying crypto asset public offers and emissions to trading, market abuse in qualifying crypto assets and related instruments, general provisions relating to designated activities, and a series of sort of amendments, savings provisions, etc. But if you look at it, particularly part 2 and the chapters in part 2, it's pretty much a clear system laying out all of the various pieces. Stable coins are separate, and but the other thing that isn't necessarily easy to find is this. So we start out with this question, regulatory perimeter. What is a qualifying crypto asset? And here, the regulation says that a qualifying crypto asset has the meaning given by Article 88F of the Regulated Activities Order. So in other words, this whole framework, which is very clear, they actually decided to stick the definition somewhere else. And you get your definition here. This is section 88F of essentially the digital assets order. A qualifying crypto asset means a crypto asset which is fungible, transferable, not solely a record of value or contractual rights, including rights in another crypto asset, and not excluded by paragraph 4. Paragraph 4, a crypto asset does not fall within paragraph 1 if it is a specified crypto asset, such as other than one specified by electronic money, etc. Electronic money, currency of the United Kingdom, so this is mainly going to be stablecoins, or a crypto asset that cannot be transferred or sold and only gives the holder to acquire goods and services or acquire goods and services within a limited network. These are what one would typically think of as tokens which are not investment products, but rather these are tokens for the use in transactions. So, fungible basically says they're all identical. We know that each Bitcoin may technically be different, but they're the same. So that's like a note. In other words, each note has a number on it, but we treat all of those notes as if they're the same. So essentially this idea that like a security, a financial product, it's fungible, transferable. We started at the very beginning this sort of functional definition of a security as something that is freely transferable. So a focus on transferability, not solely a record of value or contractual rights. So in other words, that it's not just a digital reflection, but it actually has some other aspect. It's not perfectly clear, but what they've tried to do is essentially give you a functional definition that can capture a wide range of different digital assets. Now, just because we're about to run out of time, I'm going to take a quick look at this last bit, which is this one. If we look at the SEC order, what they've essentially tried to do is reduce the scope. So in other words, they want certain things that they want to reflect as being essentially commodities. And if we look at the things that are essentially commodities, they've recognized 16 of your most widely traded tokens as commodities. So in other words, saying that these are by definition not financial products, rather these are commodities. But in the US and most other jurisdictions, commodities, even though they don't necessarily have the same level of disclosure and regulation as securities, they do come with a variety of prohibitions on manipulation, market abuse, firm trading behavior, etc. So just because something is defined as a commodity doesn't mean it's unregulated. It does mean, however, that it's regulated by the CFTC in a slightly easier manner than the SEC for securities. So some things are digital commodities, some things are digital collectibles, and these are basically your NFTs. NFTs are sort of digital collectibles. The view is that these are like baseball cards, and we don't treat baseball cards or sports cards, even though you can have all kinds of abuses and speculation, they're not financial instruments. Digital tools, which means that something similar to what we just saw in the UK pay definition. These are things which feed into various sorts of processes. Stablecoins, and your last category, digital securities. If something is a digital security, then it is by definition subject to the SEC securities regulation framework. And there are two ways. It could either be a tokenized version of a money market mutual fund, a stock, etc. And if it is a tokenized something that is already a security, then it's still a security. And certain things which will still fall into the classification of investment contracts. And our investment contract definition largely focuses on this idea that these are assets that give holders claims on business revenue, dividends, or rely on a core team for returns. So in other words, they're not saying that lots of new digital assets, that they're not all going to be securities. They're saying that many which look like traditional investment contracts will still be securities, but certain classes, like stablecoins, will be excluded, like commodities will be excluded, but for things that are digital securities, those will fall into the traditional regulatory framework. And the idea here is that what they're trying to do is establish a clearer regulatory perimeter. Not everything that is a digital asset or a token will be a commodity or a security, but certain things that have financial or investment contract characteristics will fall into that categorization. All right, I've got time for any questions, comments? Yeah.
I would like to know your thoughts on which might be the challenges or limitations in the traditional banking sector for them to adopt stable coins. JP Morgan has developed the lab since quite some years, and it has its own stable coin.
Yeah.
I know it might be challenging because other banks have not developed the same technology or have the same initiative. But if the blockchain technology provides a faster and more and cheaper a way of transferring payments cross border, why doesn't the banking sector take advantage of this technology?
Yeah, I'll give you a couple of different answers, and we'll look in that last sort of tutorial. We'll pick up a few sort of current issues, and we'll pick up some of these. The key points that I would say here is that banks have been worried particularly about whether things were regulated. But as they become regulated, we're seeing banks move in. We're expecting that a couple of big banks, maybe HSBC, maybe Standard Chartered, will get stablecoin licenses in the very near future in Hong Kong. And if we see some of the big banks getting stablecoin licenses, that will change the dynamics. You do, however, have real concerns about eating deposit bases in the same way that the US banking system lost a lot of its deposit base to money market funds. There are fears of that happening, and therefore some industry protection. And the last point, which is one that we'll come back to in that last tutorial at the end, is that it's an open question about whether the technology is always superior. I think what we're now seeing are